Hi, welcome back to the channel, folks. JD here again. This video is a little bit different. It's been provided by one of my viewers or subscribers, whatever you want to call yourselves. It's been sent to me by Chris, so thanks very much, Chris. I hope I can get your figures right. I've kind of got my head around what you're saying, so hopefully this will work. And Chris wanted to share with me something which I've kind of covered in the past, which is whereby you take perhaps an existing PCP on perhaps a reasonably high rate and you settle it with a bank loan over a longer period such that your monthly payments come down a little bit, you get a much better interest rate, and you also build in more equity into the deal so that it's easier to get out of that car some point down the line. So essentially, I've got the figures here into the old spreadsheet. I'll put a link up to the spreadsheet here for you. So let's get cracking. So Chris bought a Focus ST, and looking at what he sent me, I think I'm right in saying that it was about 17 months old when he bought it. He paid, he paid 18,300 for it, and he had a deposit of £850, a guaranteed future value of 7,480. The amount financed was obviously 17,450, which is this less this. The interest rate was fairly high at 8.9 APR, but that's not outrageous for a used car. Remember, it's often easier to get a lower rate on a new car because of the incentives that manufacturers will pass on. So it's not a bad rate, but as you'll see in a minute, we can beat it with a personal loan potentially. And he did it over 4 years. Now I've assumed, and he hasn't said this, but I've assumed it's what I call a term -1, which means on a 48-month term as this is, there's 47 equal payments, and month 48 is where your balloon payment lies. Some agreements, and this is important when you're comparing like for like, some agreements might say 48 months, but what they really are 48 equal payments, with month 49 being the guaranteed future value or the balloon payment. And obviously when you're trying to compare different deals, that can affect your monthly payment and the total amount of interest you'll pay. So do make sure that when you're looking at different terms, different finance providers, that you are always comparing apples with apples, so to speak. So it came out at £307.50 a month or thereabouts, certainly in this example. And what he's done, he is currently about to pay his 15th payment, I think. And he's looked at what the settlement figure is on the PCP, looked at what he can get a personal loan for, and then compared A, what his monthly payment will change to, and B, whether there'll be any more equity in the deal at different points down the line by getting cap valuations, or in his case, valuations from We Buy Any Car for this particular car at certain ages. Now obviously again, it's not that scientific because who knows what's going to happen with car valuations in the future, but what he's done is basically, like I've done in the past, he's taken that model of car and got a valuation at different ages, if you like, up to 4 years, because you can't, he tells me you can't get a valuation on a 4.5-year-old car yet. So let's have a look. On the PCP, roughly £307 a month. So when the car is 3 years old, so that's after 19 payments have been made, because remember it was 17 months old at the start of this agreement, so 17 plus 19 is 36 months. He's got a rough valuation of £12,500, and using the spreadsheet, the settlement is coming out at around £14,023. So we're £1,500 plus in negative equity. Now, for those of you using the spreadsheet, I always do explain that these settlement valuations are a good estimate, a good indication, but they won't be precise. And that's because finance companies may add an admin fee to settle. They may be applying a certain amount of a certain extra daily interest rate charge, hence why there's two columns in here. There's a column with up to 58 days interest applied, and there's a column without any additional interest applied. So I'm using this column. So essentially we're about £1,520 odd in negative equity. When the car is 3.5 years old, so that will be month 25 of the agreement, okay, because 25 months plus 17 months gives you 42 months, which is 3.5 years old. The cap value is, sorry, I haven't put this in, 11,810. So again, nearly £1,000 in negative equity. And when the car is 4 years old, so what's that, 31 months into the agreement, because 31 plus 17 months is 48 months. As you'll see, it's not dropped very much. So that's why it's good to buy an older car, because you can see from 3.5 years old to 4 years old, it's only dropped, what, £170. We are £214 in positive equity. When the car's 4 years old, 31 payments have been made. However, then what he says is, okay, he's got a price to borrow the settlement figure at this point. Now, he has mentioned a slightly different figure, so this might be an exact settlement quotation he's got from the finance company, I'm not sure, but I'll use the figures that the spreadsheet's producing, and it's saying roughly, let's assume there's no extra additional interest payable, £14,833 to settle after 14 payments, so kind of the start of month 15 into the agreement. So we go to somewhere like Sainsbury's Bank, Tesco, and let's assume we can get the headline rate. Now remember, the headline rate doesn't always have to be offered, and it will be dependent upon your personal circumstances. Banks only have to offer the headline rate to 51% of applications, so let's remember that. But let's assume we can get the best rate, which at the moment is 2.9% APR. So we're borrowing the settlement figure from the previous agreement after 14 payments, which is £14,833.10. Obviously there's no deposit, there's no guaranteed future value because it's not a PCP, and we've got an APR of 2.9. And he's done this over 60 months. Okay, but remember, this is 60 months to pay the loan completely down, not a PCP. You know, a PCP, you're offsetting, in Chris's case, £7,500 after 4 years. Okay, so you might think, well, it's a longer term. Well, yes, it's a longer term, but you're paying it down to zero. First of all, monthly payments coming out at £265.87, which means each month we are saving £40.64, which is the difference between £307.50 on the PCP and £265.87 on the personal loan. So that's a good start. Let's have a look at equity in the car. So this time, the car is 3 years old when we have made 5 payments on the loan. Okay, because remember, the car was 17 months old at the start. We've then paid 14 payments. Is that right? That's 30. That's right. That's 31 months old. And then 5 months into the loan, I told you this was complicated. 5 months into the loan, the car will be 3 years old. The cap value is £12,500, which is exactly the same value as this one here, look, £12,500. And on the personal, on the PCP, we were £1,500 odd in negative equity. In this case, we are £1,239 in negative equity. So we're still substantially in negative equity, but we're going in the right direction. We then get to the car being 3.5 years old. So that's another 6 payments into the loan. So we're now at month 11. And again, the same We Buy Any Car value of a car 3.5 years old is coming out at £11,810. So we're now only £517 in negative equity, compared with £943 in negative equity on the PCP. And finally, at 3.5 years old, at 4 years old, remember we said it hadn't dropped much, so another 6 payments have been made, and we've got a We Buy Any Car value of £11,640, and we're now roughly £740 odd in positive equity. Okay, let's compare that when the car is 4 years old on the PCP. We are only £214 in positive equity. So what does that mean? Well, it means that we are saving £40.64 over 17 payments, because that's when the car is 4 years old. 17 months into the personal loan, I should say. 31 months into the total PCP, if you see what I mean. So we multiply that by 17, we have saved £690 over 17 months. And our saving in equity, because remember we are only £214 in equity on the PCP, compared with £744 in positive equity on the loan. So the difference between those two figures is £530. So there's a total potential saving on this car, switching from the PCP to a straight 5-year personal loan, of over £1,200. I hope that makes sense. I've confused myself trying to get my head around Chris's figures, but I think that was right. Again, thanks very much, Chris, for sending that in. If anybody else wants to send me any examples using the spreadsheet, any tips, anything you've found, it'd be really interesting to hear from you, and I can share your good news stories with everyone else on the channel. So again, thanks for watching. Please comment and subscribe if you haven't already done so. I'll put a few links in the description to some other videos, and I'll catch you next time. Thanks for watching.